Join us now to talk markets from a technical perspective. Katie Stockton, Fairlead Strategies founder and managing partner and a CNBC contributor. You definitely get cut more slack, Katie, because you're a trend follower and a technical analyst. As far as Mike Wilson, he's still bear. I mean, 4,200. We're at 45 and change. So, but if you were him and you had been, if your bearish case was 3,000, which he was still talking about on the S&P, maybe his average was 34 or 3,500, and his bullish case was 3,800. You got in stepwise fashion. You got to say I was wrong. So we'll start at 4,200. So when he finally changes it to 4,900, it won't look so crazy. You can't go from 3,200 to 4,900.
Right. I mean, the revision's appropriate, it seems, just based on where we've come from.
And based on his keeping his job and his career, being able to say that I have value in what my forecasts are.
I think Mike's great. I have to say, so when we see breakouts occur, it allows us to ratchet those support levels higher and kind of creates a new normal for the market. Now for the S&P 500, with the breakout that we saw back in May, the new support is, we are looking at not only the 50-day moving average as an initial level, but former resistance, which is now around 40.65. It's
somewhat helpful in hindsight, but if you are following everything going on with either Mike Wilson or following the trends you're not in, so it's nice to have an explanation for why you felt like it wasn't a good time to go in, but it doesn't help you with your strategy to do things, does it? What should we do now? Buy or not buy?
Well, sometimes it's just momentum, right? And it doesn't.
So do we buy into this momentum?
It doesn't need to have an explanation for it. It's just market sentiment that's driving it.
But getting people to do, but recommending what people do with their money,
of course,
is why they watch and why they want to take advice.
We're still bullish right now.
When did you turn bullish?
Back in May, when the S&P 500 broke out. Remember, we talked about a target of 45.10.
But it wasn't going to go much further. It wasn't going to go much further, though, right?
Well, 45.10 was our objective, and we're past that. I mean, we're at the place where we have the S&P 500 facing resistance around 4,600. We do see some minor signs of upside exhaustion as we get into a lot of earnings flow and what have you, but we're still recommending that our clients hold onto their equity positions. We're not any longer recommending that they add exposure. And we say that because we are seeing less in the way of positive technical catalysts. We saw a lot of breakouts between May and just recently, but they're starting to quiet down a bit. And earnings season, so far it's fine, but it's not generating more of those breakouts.
So we're getting close to the end. What was the level in May on the S&P?
It was 41.55, if you recall. That was the resistance level. It was based on our cloud model, which I think we've become somewhat known for in terms of a threshold and a trend following device. So that cloud model, which was at 41.55, now shows support. It's a bit lower at 40.65.
But we were thinking it was the high end of the range at 4,200. And it was likely to fail.
Yes.
When did it? Yes. So the breakout. What was the number when you thought it was an actual breakout?
Around mid-May, around 41.55 when we saw
but we
those.
Still weren't at 4,200 then, and at that point.
So the 4,200, that might have been an older level. I'm not sure, or a rounded level, but it was when we broke out above that 41.55 threshold.
And you expect the bond market to sell off again?
So in terms of the Treasury yields, I mean, we do think they'll come in a bit here near term, farther from their recent highs. That includes 10-year yields, 2-year yields. And at the same time, we're looking for Treasuries to rebound within their trading range. So a trading range is in place.
You mean the bonds themselves to rebound, or the yields?
The bonds themselves to rebound.
So will we go back above 4%? And well above 4%?
Eventually, yes, but not in the near term. The indicators still point lower. We've been talking about this year in yields as a corrective year following the secular shift higher that we saw preceding this consolidation. So we think the consolidation will continue based on our indicators, but that it will ultimately yield a higher low and higher yields.
If the Fed goes another, so they go 25 tomorrow, let's say, and what if they did 2 more? Wouldn't the 10-year just be way out of whack for where the Fed is at that point? How does that reconcile itself?
Yeah, I mean, ultimately, you'd think it would create a breakout, right, in yields.
Yields would go up.
Right,
so
right.
You have an eventual 4.5 on the 10-year, do you think?
If we were to see the 434 resistance level cleared, the next resistance is about 5.25.
5.25.
So I don't think it's a near-term concern, if you want to call it that, but I think it is something that we have to, sort of put our sights on perhaps later next year. I do think it's realistic based on the chart itself. And yet, in the near term, they still do point lower. And
then the 2-year would be going up as well, but probably not as much. So they might get close to one another, and then the world looks kind of normal.
And it would narrow. Yeah, that gap would narrow a bit.